Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. Kansas City wheat. The key patterns here for many months now have been late March to late June diamond pattern type, with the extension of its lower uptrend highlighted in bright green on my daily chart, and the larger, big inverted roof pattern, sometimes called a half diamond, which is highlighted in purple on my daily chart. Prices managed to reach the primary topside target of the first diamond pattern type, but failed to make it to this harder to reach secondary target. Then in early August, the market punched down through the purple uptrend of the inverted roof pattern, and has headed lower ever since. So where does it leave us now? I said when the move lower started, and I quote, a primary target X2 for the inverted roof stroke half diamond pattern will be down in the 733 zone, with a secondary harder to reach target X3 down at 646. There's only the first few days of the move lower, so it could still be a false break, but those are the potentials for such a pattern as this inverted roof pattern. End of quote. The move lower, now obviously not a false break, reached the primary target in the 733 zone in late August, with the market continuing lower. The move down at the end of September broke down through some very interesting supports that are now resistances and should be noted, specifically the big 50% absolute Fibonacci line at 697 and the 50% Fibonacci line of the 2011 to 2019 move at 691. However, most of October has been primarily hesitation, and even some small recovery over the 50% Fibonacci line at 691. As I said 2 weeks ago, and I quote, we are seeing the market edge ever closer towards target X3, but it is still a cautious move lower. End of quote. The one new feature is to regard the action since August as a possible descending expanding wedge pattern, currently 627 to 710. Which I have this week highlighted in dark blue on my daily chart to aid ease of viewing. This would not be the best example of such a pattern, but it does hold merit, and I would look to this pattern for some immediate idea of the moves downwards. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had been somewhat easier to read in recent times, with respect to what was going on and what the opportunities might be. This is no longer necessarily so, but it still has its moments. In late February, and especially at the start of April, the market constructed a large bear channel that morphed into what we see highlighted in dark blue on my daily chart, which is a descending expanding wedge pattern, currently at 817 to off the bottom of my daily chart. This originated from December last year, but really became evident from February this year. The upper trend line has been reinforced, well, sort of, by the declining medium moving average, currently 812, which combined together to help cap the market back in very early April, then mid-April, mid-May, and mid to late June. However, in mid-July, the attempts higher resulted in a clear break above the upper trend line, and also the important declining long moving average, currently at 837. Prices climbed rapidly up to the 50% Fibonacci line, the significant August 2020 to May 2022 move at 955, where the rally petered out and turned back down. It is this turn back down that has captured my attention, as the market has, since late July till mid-September, formed a descending scallop pattern. Not only that, but since mid-September we have seen the market form the ski bump of the descending scallop pattern, and since the start of October start on its journey lower. Now, the lower targets, potential targets for such a pattern below. Thus, a primary target X for such a pattern would be in the 708 zone, with a secondary, harder to reach target X1 in the 689 zone. Last week, the market made a valiant attempt to turn back up, but the May low at 769 capped the rise with a daily bearish double pattern. Last Friday that was, and turned prices lower, such that we are again testing the significant 737 support. As I said last week, when we were then testing higher, I am not overly certain if prices can easily break topside, or now this 737 support, as the ammunition gathered during October does not look that substantial. And so I would still keep an eye on the May low, The July low at 778, the descending short medium moving average currently 772, and especially to the trend lines of the nascent late August to date bear channel I spotted last week and this week highlighted in bright red on my daily chart, and that's currently 706 to 784. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.